We've talked before on Lunch Money about the capital overhang. There's a lot of money out there. Low interest rates. We talked about low interest rates last week. Means that there's a lot of money looking for returns. And I guess what that article's talking about is that now companies that would not normally be able to easily raise debt capital are finding it easier and easier. I mean, I think one of the comments was that there's an excess of demand for bonds in terms of investors. There's an excess of investor demand for bonds in terms of supply. And certainly when I look at the Australian situation, certainly investable companies, there would be not enough investable companies for all the money out there. I mean, what do you think? Did you see this as a problem down the track, Neil, or what's your take on that?
Well, I think money's cheap. I mean, that's what you've pointed out the last couple of months on this program, and I'm not sure that's going to change anytime soon. And bond rates are low, and 30-year-old bond rates are low, and the effect on retirees is significant. But these companies and the share market particularly, they've got to put their money somewhere, and you look at the All Ordinaries, it's going to be at a level next month of where it was when we hit COVID, and you look at, well, how can that be if the underlying profit of our companies hasn't been there? Obviously, there's some companies done very well under difficult circumstances, but not that many. So it'll be very interesting.
What about yourself, Michael?
Look, I think a couple of points of view. I think whenever there's cheap money around, I mean, they want to place it, don't they? I mean, they're looking for some form of return and activity. They have to create activity because they can't sit on the money that they've raised. It's a problem for them. I can never find it when I'm looking for it, if I'm honest with you.
All right.
It's always available on the right days.